Hey guys, hope you are all having a great day. Today I want to talk about this investment opportunity that could create a ton of value for all shareholders. It took me a while to find this gem and today I want to share it with you. Before we start, consider joining my Discord. We have day trading signals, a robust community, educational material and much more, all for you with a simple click on the link in this video's description. So, the time has come to finally talk about Paramount Global, both one of the riskiest and highly lucrative potential investments you can make. Paramount Global is a media giant that operates through 4 different segments: TV media, direct-to-consumer and filmed entertainment. Their TV media segment operates CBS TV Network, CBS stations, Showtime, MTC, Nickelodeon, Comedy Central and many others. Their direct-to-consumer segment provides a portfolio of domestic and international pay and free streaming services like Paramount+, Pluto TV, Bet Plus and Noggin. Their filmed entertainment segment produces and acquires films, series and short-form content. Some of the most notable intellectual properties they own are A Quiet Place, Cloverfield, G.I. Joe, Friday the 13th, Iron Man, Mission Impossible, Star Trek, TMNT, Terminator, Top Gun and Transformers. Paramount Global has seen a significant devaluation over the past couple of years. However, the trend began back around 2016, with a notable break in 2021. The reason it has fallen so much has been largely attributed to their streaming segment. The company also has a large amount of debt, though that seems to be decreasing. More on this later. Though Paramount Plus streaming service has a 39% revenue increase around May 20, 2023, the streaming channel remained unprofitable, with the other business segments Paramount has also reporting operating losses or falling operation profits. As a result of those weakening margins and, in an effort to conserve cash for the benefit of content production and financial flexibility, Paramount decided to cut its dividend payouts. Even Paramount's largest shareholder, Berkshire Hathaway, decided to trim down their positions recently from almost 94 million shares to 63.3 million shares. The reasons for this were to capitalize on tax loss harvesting alongside a lack of trust in the prospected sales process. Other reasons for why investors remain uncertain about Paramount being a good investment lies in the fact that the company's profitability still remains tied to their declining TV media segment. As such, that decline tied with the large debt and the fears of their streaming segment taking quite some time to turn profitable has turned investors away over the years. The risks are present and the stock could potentially see more dips in the future. However, I strongly believe that the company's valuation is currently sitting at an attractive valuation. Furthermore, I think their ability to turn their business around is more likely given the valuation of some of its networks and their ability to potentially sell them off to service their overall debt and boost content production. If that isn't enough, investors should take note that the company is very attractive to other companies who have shown interested in buying Paramount Global. Let's address these two opportunities separately. As mentioned earlier, Paramount underwent a very disappointing fourth quarter earnings call. Their revenues were down 6.15% year-over-year and were also down 27.3% quarter-over-quarter. This was mostly brought about because of the company reporting lower TV media revenues of $20.08 billion, which was negative 7.5% year-over-year in fiscal year 2023. Their direct-to-consumer segment has significantly helped mitigate the losses on the TV media segment, as they reported growth on it to the amount of $6.73 billion, which was a positive 37.3% growth year-over-year in FY 2023. The issue lies that Paramount's direct-to-consumer segment has not generated any profitability yet, which is why the bottom lines continue to suffer in total even when that segment took away much of the losses. When you take this information and add to it the $14.6 billion in long-term debt with higher than average weighted interest rates of 5.17%, the issue becomes apparent. So how bad can it get? Well, their weakest segment, TV media, is expected to worsen over the coming year. This is because of changing trends in society. Nielsen reports a steady decline in cable viewership over the months, a trend that will continue as people continue cutting cable and replacing it with streaming services. This is why Paramount Global's TV media segment is expected to continue worsening. The silver lining in the situation lies in Paramount's streaming service. Paramount Plus continues to report stronger user retention and growth on user acquisitions, with their subscriber count growing by 11.5% year-over-year to a total of 67.5 million users. This growth trend is expected to continue into 2024 according to Paramount. In fact, management is so confident that they guided sustainable profitable growth for fiscal year 2024 and beyond. They said that domestic Paramount Plus profitability is expected to be reached by 2025. The biggest benefit that Paramount Global has that the rest of the market seems to not realize is that the value of the sum of its parts. The company owns countless businesses and brands, which when combined, are worth far more than the valuation of the firm itself. It's currently trading below its liquidation value and a strong likelihood that their business will yield higher revenue and profits. Let's go over the liquidation value. For context, at the time of me writing this, which is April 19th, Paramount Global shares are trading around $12.01 with a market capitalization of $7.49 billion. Paramount Global has received many bids for some of its franchises such as BET, Simon & Schuster, and even their own CBS Studios location in New York City. Some of them they have rejected, some of them might be under discussion. The importance of bringing this up is that it brings us context. Many sources claim that Paramount's price tag on BET is in the ballpark of $3.5 billion. There seem to be various parties interested in acquiring BET, which means Paramount is likely to sell it at a premium. These sources include Tyler Perry, Byron Allen and Urban One according to various reports. Their CBS broadcast building in New York City is up for sale. It remains unclear how much Paramount is asking for the property. Estimates put the amount somewhere around $1 billion. If you combine the valuation of these two assets alone, it tallies a valuation of $4.5 billion, reaching over half the current market cap of the Paramount Global itself. They already sold Simon & Schuster to private equity firm KKR for $1.62 billion cash last year. Those three assets mentioned above, Simon & Schuster, BET and the CBS broadcast building, near the entire market capitalization of the company at its current price. Paramount Studios, the crown jewel of the company, is worth $19 billion according to Wells Fargo. National Amusements is worth around $2 billion, and CBS alone is worth $5 billion. As you can see, analysts' valuations of the sum of the parts of the company are much higher than the total worth of the Paramount Global itself. In fact, the valuation is so attractive that the company is primed for acquisition, and they have a long line of interested parties. The latest round of news has it that Sony Pictures Entertainment is in talks to join Apollo Global Management in its $26 billion bod for Paramount Global. If the deal is consummated, Sony would control a significant majority stake in Paramount. It's important to note that Sony and Apollo haven't formally made a bid for Paramount. Instead, they are on the sidelines at the moment while an exclusive 30-day negotiation period takes place in which Paramount's independent board of directors hold discussions with head of Skydance Media. Skydance's approach is to do a takeover of Shari Redstone family holding company National Amusements, which would then allow them to merge Skydance with Paramount. Redstone, which is Paramount's controlling shareholder, has long preferred the Ellison deal because she doesn't want the company, but the Ellison proposal has generated strong backlash by Paramount investors who contend the deal would benefit Redstone and not regular shareholders. The deal between them is unlikely to close in the 30-day window, however, but seems to be moving forward according to some sources. When you put everything together, there are three main outcomes for Paramount Global, which I will list from best to worst. 1. The company doesn't sign any deal for any type of merger or acquisition, and instead focused on servicing debt and continuing to grow subscribers as much as possible. On this outcome, I think the company comes out on top over time, and the valuation, according to some metrics, could drive shares up somewhere between $30 to $40 over the next couple of years. The company is certainly making a turnaround, and as their CEO Bob Bakish said, they expect the business to drive profitable growth in 2024 and beyond. 2. Paramount rejects Skydance's deal and instead opts to move forward with negotiations from Apollo's deal. This process would be a lot quicker and simpler. Current shareholders would get cash on their hands for their shares, which could be anywhere between $21 to $30 depending on what the final outcome of that negation is. 3. The downside of this would be shareholders don't get to really see the company turn around, as it will be owned by the private equity firm and in the long term would probably miss out on what could potentially be a valuation per share amounting over $50. Still, the deal is pretty good and puts cash on the hands of investors. The third outcome is the most controversial one, and one that could actually drive your investment down in the short term. The buyer consortium, which are Ellison, KKR, Redbird, Skydance Partners, etc., want 45% to 50% equity stake in the new combined company, which would be Paramount Global and Skydance. These buyers will step up for a good amount of equity via cash infusion most likely, which will likely dilute shareholders. Initially, this dilution, which will affect all existing shareholders, including myself, would see the valuation of our holdings go down, but that would only be temporary. Again, and this is in conjunction with outcome number 1, the company would certainly recover. Shareholders would not get the cash and instead would have to wait to see how the market reacts to this new company, which would be a symbiosis of Paramount Global and Skydance, like I said. New valuation and ratings would certainly be casted. With reduced or even served debt, the valuation on this company might pick up very rapidly. We do not know the details as this deal is still being discussed. Let me stress out that this company is being eyed or has been eyed by other corporations. Even Warner Bros. Discovery held private talks for a potential acquisition a couple months. Lots of institutions understands the value proposition that Paramount offers, especially given the fact that they trade under a market capitalization less than the sum of its parts alone. The company is making a quick turnaround and they could very easily sell off the portions of the business that are not growing as fast as they would like and use the money to service their remaining debt or to boost their growth. Personally, I am okay with any of the 3 outcomes discussed. The risks associated with this investment lie in that if shareholders don't get cash, it might take some time to watch Paramount Global grow, and I am in no rush in the event that happens. However, if this Skydance deal falls, we will likely see Apollo and Sony make a strong case for purchasing them, which could see share price appreciation. I will personally be adding Paramount stock to my port in the foreseeable future. I think the company has dipped enough for it to become obviously attractive and an easy buy considering financials will improve regardless of what happens and an acquisition is in table as corporations want to buy in. Let me know what you guys think in the comments down below and I hope to see you on the next video. To the moon.